Everybody joining. We'll be starting in about a minute or so. We're waiting on a few people, so sit tight. All right. Are we good to go? Shall we begin? Let me just begin by first extending gratitude for those who are present. I think we're ready to get started. We'll have a few people that come in a little bit later, and welcome joining us to Greenlee's webinar, Turning Climate Risk into Strategy, Leveraging Tech for IFRS. My name is Victor Green. I am a Climate Engagement Manager at Greenlee. I'll be monitoring the chats throughout for any questions that you may have, as well as providing a link at the very end if you wanted to continue the conversation further and start putting your strategies into action and learn a little bit more about Greenlee's platform. But today, we are pleasantly delighted to have two of my favorite people. We have Sarah Ben-Moussa, Greenlee legal resident, as well as Greenlee ESG expert, Thomas Marie. Thank you both for being here, and it's a pleasure. We can take a look at the agenda, I think, at this point. We will have some time for Q&A at the very end. I did mention that the chat will be open, so I'll certainly try to collect a few Q&As that we can maybe address, time permitted, for sure. But we'll begin certainly first and foremost with Sarah giving an IFRS overview. And then we'll end things off with Thomas about leveraging tech for IFRS. By way of introduction, I think it makes sense for us to kind of set the scene with global regulations, as I'm sure you've heard, converging on a single baseline for sustainability and financial reporting, understanding IFRS standards, how they integrate with frameworks like TCFD and SASB is now essential for any company navigating investor expectations and regulatory compliance. And so, with that as inferred and appropriate strategies pending, I think it's makes sense for me to hand it over now to Sarah and Thomas. Sarah, thank you.
Hi, everyone. Thank you so much for that introduction. So I think to start us off, I want to get into the definitions of TCFD, IFRS, ISSB. You're going to see this a lot. There's what we call the alphabet soup of ESG regulations. So I think in order to really have a productive discussion, we first want to orient ourselves. And so definitions of terms. So I think to give sort of a brief overview, I won't get too into the weeds, but essentially it makes sense to talk about the IASB. So the IASB is sort of the successor to the International Accounting Standards Committee, the IASC. You don't have to remember that one. That was formed in 1973. Moving forward to 2001, you have the International Accounting Standards Board, which replaces it and takes it on. And then which takes us to ISSB. Essentially, the board was created in 2001 with the intent of developing sustainability disclosure standards. So the IFRS Foundation is essentially the foundation that founded this board. So in terms of the sort of hierarchy of norms, you have the IFRS Foundation, you have the board that's specifically tasked with the sustainability disclosure mandate, and that is how we birthed the IFRS standard S1 and S2, which we'll get into later. TCFD is kind of on its parallel track. It was formed in essentially the Financial Stability Board, the FSB. You'll hear that one thrown around. Was formed in 2015, and they formed a task force on basically it was the Task Force of Climate-Related Financial Disclosures, TCFD. So you'll hear that one thrown around a lot. It was an investor-led framework for climate risk. What has happened since then is that IFRS S2 has fully absorbed the recommendations of the task force, which has since been disbanded. And so when you hear people say TCFD, just know that IFRS S2 and TCFD can be used interchangeably now because anything in S2 will include TCFD. The last one is GAAP or GAAP, depending on how you pronounce it. And these are generally accepted accounting principles. So for instance, US GAAP. The sustainability standards can work with any GAAP. There are differences between the two, but typically in contracts, you'll see references to GAAP. Just know that this is what people are talking about. So that's a little bit of, and we'll get more into the detail about this, but that's a little bit of the history. So here's some of the dates I was mentioning, just for you to visualize it. You have the IFRS, ISSB, which was launched at COP26. And then in 2023, you have S1 and S2, which are released. And then you have TCFD, SASB, and then the integrated reporting, which is integrated. Just for your own sort of edification, because again, I said I know this is alphabet soup. SASB is the Sustainability Accounting Standards Board, the International Integrated Reporting Council, Climate Disclosure Standards Board, and the Value Reporting Foundation. We're not going to get too into that, so I won't kind of go too in the weeds there, but that's just for your own edification if you want to look at that later. And so what are IFRS S1 and S2, now that we've sort of oriented ourselves in where we are? So S1 are the general requirements. They look at broad ESG risks and opportunities. It's principles-based, not as rigid as some other frameworks, but it is quite detailed. And S2 specifically applies to climate. These are more detailed prospective disclosures on climate. We're talking about scopes 1 through 3, targets, transition plans, scenario analysis, industry metrics. The thing to sort of remember here is that S2 works within the framework of S1. So S1 is sort of a generalized standard and S2 gets more detailed. But typically they work together. And so why the IFRS was created. So if you can't tell by this point, we are in a bit of a transitionary phase just because in the excitement to get ESG standards formed, there were a lot of groups formed at the same time with competing standards. And what that has created is a sort of confusion for businesses writ large. There's a lot of ESG standards. They're all somewhat similar, but slightly different with different focuses. And so the idea of the IFRS was to have a centralized one framework to rule them all, global accounting and sustainability disclosure standards. And so the aim is to have this be consistent, transparent, and to be able to use it across businesses and sectors. And so I think at this point, the IFRS has reported that they are in use in about 168 jurisdictions. So why was the IFRS created? As I mentioned, solve a bit of the ESG confusion, the alphabet soup, as I like to call it, ensure consistency, comparability, transparency, and really to have a global baseline recognized by IOSCO. For those of you who have worked or are working in securities commissions, you know that a lot of the exchange commissions have their own memorandum of understandings between each other. And one of the big pain points between these organizations happens to be reporting rules that perhaps conflict and also enforceability. And so I think there's been a really big push, especially in the last 2 decades by IOSCO, to sort of standardize and particularly collaborate between exchange commissions to make sure that laws are coherent, that they work between jurisdictions, that people are able to sort of, with the nature of cross-border transactions being what they are, that people are able to sort of enforce a regulator within one country isn't impeded by funds moving around in other jurisdictions. So there's been this real emphasis, I would say, writ large, both in ESG and across and across frameworks to have this idea of cooperation, centralized frameworks. And you'll see that a lot, particularly in the discussions coming out of the G20. It's really investor driven. I think the idea is that sustainability disclosures, they affect a lot of variables in transactions, cash flow, capital access, cost of capital. And the idea was to have a framework that worked for investors. So what are the risks? Now that you know sort of why it was created and what the aim was. All right, so essentially it was made to address a few things. There's the financial risk. You have compliance penalties if you are not in line with some of the laws that are being passed by various jurisdictions. Long-term strategy, I think for businesses as IFRS grows, there is a risk in terms of focusing on short-term strategy of not being ready for some of the developments that are to come. And there's a risk of losing a competitive edge. I'm not part of, full disclosure, I do not work for IFRS. I'm not here to pledge IFRS. I think what we are seeing, we're reporting on what we're seeing. And what we're seeing is IFRS is sort of the talk of the day. And we're seeing a lot more jurisdictions folded into their like upcoming ESG legislation. And it's a bit everywhere at the moment. It's kind of why you're hearing it as a buzzword in so many conferences. What are some of the other risks? I think generally in the context of ESG, we have to orient ourselves in the world we're in. And so climate risks and including, you know, fires, floods, coastal erosions, natural disasters, and heat waves. I think from a practical standpoint for many businesses, what they're looking at is, I think a notable example, if I could give one, is I was talking to one of the management members of a notable vineyard out in the Napa Valley. And one of the things he did mention is, you know, we're a winery, you know, we're producers of wine. And so, you know, we never really had to think about ESG and climate change. But one of the big things that has been happening is because it's getting warmer in California, the plants are not well adapted to the changing climate. And so a lot of what they've had to do is look into their own the ways in which they could change their business models to sort of adapt to that. And so I think what you're seeing generally is a sort of mood, to bring it back to IFRS, is a sort of move towards, there is an inevitability that can't be ignored, whereas like IFRS, the move towards IFRS is largely regulatory, but those regulatory moves are rooted in a changing reality that we frankly can't really fight. So I think the idea is, regardless of sort of the sways, we are seeing regulators for the most part move in different speeds in that direction. So I think these are some of the risks when it comes to figuring out whether or not you want to move towards an IFRS model. And to kind of go off that, we're talking the real business concerns. It's largely regulatory. I think, you know, I touched upon earlier the concrete consequences of climate change in terms of business. Other than the winery example, I think there's been a few examples of situations where wind turbines have exploded or malfunctioned due to, you know, just the heat in certain regions of the summer. And so I think what you're seeing is a market evolution. What you're seeing is a move, again, depending on the jurisdiction at various speeds, but a demand shift, both from a client perspective and from an investor perspective. Investors are demanding, you know, decision useful ESG data, particularly when it comes to value chains. A lot of, notably, I believe when CSRD came out, a lot of the discussion had to do with sort of the value chain. And even as you're seeing sort of the reporting deadlines being declined, that is something that's sort of sitting in the background, is for some of these bigger entities, there are a number of reporting standards that will have to come out for value chain. And it's interesting to see, we'll talk a bit more about interlopability later, but to see how IFRS plays into this. And so we're seeing, you know, regulators, and I'll talk about this more later, but regulators are really looking to IFRS as sort of the standard of reporting. And, you know, for businesses, there's a risk of penalties, as I mentioned, but also assurance costs. There's a lot of auditing that has to be done. under some of these regulations and scope 3 complexity. Some concrete examples here are SB 261, so that's the California regulation that's currently being, it's been passed, and the reporting is set to start in January 2025. So the California Air Resources Board is looking into exact penalties, but under the law, essentially the references say it can go up to 50,000. What that means concretely, we will see. And then some of the Australian compliance laws that come out have penalties, including false or misleading statements, resulting in up to 15 million or 10% of annual turnover. Again, these are ceilings, but it'll be interesting to see how these are applied in real time, practical cases. We're really at the cutting edge of this sort of legislation, and so we don't have a precedent for how it's going to apply. So it'll be interesting to watch in the interim. And so I alluded to this a bit, but let's talk about the regulations. We talk a lot about regulations, but what's happening. And so we're looking at a few. Essentially, the way it works, sort of blanket statement, is regulations will pass and they'll sort of have these disclosure requirements. They're a bit broad. Typically, when you look at the text of the law, under many of these jurisdictions, there's this sort of generalized ESG reporting requirement. To make things easier, a lot of these, so it depends on the jurisdiction, but California, for example, uses the example of TCFD style reporting. And I think there are some, the UK is a little bit more literal. I think they actually reference IFRS specifically. But I think we're looking between the years of 2025 and 2028 for phased implementation, depending on the jurisdiction. And I'm happy if there are questions to get a little more into that. And many of these are looking at large listed high revenue companies, but there is a wave effect. And so I think a lot of regulators are waiting to see how it works with some of the bigger enterprise candidates. And then we're expecting, depending on the jurisdiction, eventually some sort of phased reporting. And then I think we'll talk a bit about auditing, but for the moment, there's going to be a sort of phased auditing. Let's take a step back and orient ourselves. So I'll kind of go one by one here. The United States, I would say, it's a bit of a mixed bag, depending on the level you are looking at. But I am conscious of the fact that I threw a lot of information, so I want to take a minute and pause. Victor, are there any questions in the chat? I think we did a lot of fixing and orienting there.
Yeah. Thank you. Yeah, there's an acronym for everything is what I often say to everyone. But we had one question, and it's a common one, which is differentiating between CARB laws, like the California laws, and TCFD. And maybe an extension of that too is just some of the variances between the frameworks, disclosures, and regulations. But if you can comment on that, that'd be great.
No, sure, I'm happy to. I think what is confusing about it, again, is there's too many terms, candidly, is the main problem. So essentially, and also, frankly, the wording's a bit outdated in some of the legislation. I think by the time you get to the finalized versions, these laws take so long to write that perhaps they don't really have the most up-to-date terminology. Typically, what the California laws mandate are a sort of disclosure reporting. So TCFD or IFRS are not mandated under California law, but they want a sort of cohesive disclosure report. That being said, when the California Air Resources Board issued an FAQ, the example they used was a TCFD style report. And so I think we're waiting for them to be a bit more clear on the guidance, which frankly, given the first reports are due in January, is a bit silly. But I think the idea is what investors can take away from that is that if you put together a report that follows the recommendations under the TCFD, you should be good to go under like CARB's interpretation of the law. That being said, the TCFD has been disbanded and is now absorbed into IFRS S2. So IFRS 2 is a little bit more broad, but basically if you style your report such that it's compliant with IFRS S2, you should be fine with not only California, but a lot of these other jurisdictions. And so it's a bit confusing how we get there, but the sort of takeaway is IFRS 2 kind of has you covered.
That's super helpful. And I don't see any other pertinent questions. I do see Robert's typing, so I'm going to just pause. Oh, thanks. That helps. Great. If you do have any questions, though, again, please don't hesitate to put them in the chat. We'll do our best to address those. Certainly, with some time at the end for some Q&A. Sarah, I didn't know if there was anything else that we maybe needed to add at this point, or if we were able to, we ready to transition.
No, I'm happy to get into it. I just know it's a bit in the weeds. So please, to the extent anyone has a question, please stop us. We're more than happy to sort of backtrack. But if not, I'll get back into uh, the regulations themselves. So I think this is the part where we hold our breath because it can get a little dicey. But the United States. Okay, so basically the long and short of it is it really depends on whether you're looking at the federal or state level. At the federal level, as some of you may know, there were formerly SEC climate disclosure rules that were meant to be enacted in place, and those were meant to encapsulate sort of TCFD style reporting, which again now means IFRS S2 for all intents and purposes. The SEC disclosure rule, not to get too technical, is in a very weird limbo. So the rule is promulgated, it exists and it's on the books, but it is not currently being enforced by the current administration. There is a lawsuit in place, and the last update was that the Eighth Circuit Court of Appeals essentially kicked it back to the administration and said, you kind of have to do something with this rule. It can't sit in limbo. Either you start the formal procedure of rescinding it, which is for anyone who works within the SEC sort of universe knows it's really just administratively, it's a long process to promulgate any sort of rule. So it's a big notice and comment period, and it's a whole sort of to do. It could take a few years. And so, but essentially the court kicked it back to the executive branch, and they were like, do something with this. So either rescind it or don't. Essentially, it's really on the executive branch to do something with it. As of now, it's not being enforced. So it's the law on the books, but it's not being enforced. So as of, I won't say it's dead, but for those of you that have watched The Princess Bride, it's mostly dead. So we're just putting it on a shelf for now. So federally, we're not really seeing the same sort of application. That being said, on a state level, there's a number of states that are sort of charging through, California being the most notable of them. And so California is sort of on it being the fourth largest economy on its own, is sort of charging through. They're going to have these disclosure requirements that are starting as early as 2025. There's a portal on the website. We're also happy to provide those resources, but there's a portal where those reports are going to be sent to once they're finished. And they're looking at IFRS S2. The UK similarly has the UK SRS, the Sustainability Reporting Standards. It's pretty much based directly on IFRS S1 2. It's not yet enforced, but they, I believe, are looking at 2026. So the European Union's a bit different. You have ASRS, which is the European Sustainability Reporting Standards, if I'm not incorrect. But these are issued by EFRAG under the CSRD, but they're aligned with IFRS. And so I think the idea is the European Union want to put more of a burden on investors. So these are very IFRS aligned as well. Canada, similarly, Australia, as I mentioned, and I believe we also have Chile, Singapore, Hong Kong, and Brazil have their own standards in discussions. There's nothing, I think for each of these, and I'm happy to get into it, there are some market specific disclosure standards, but we're watching them to see sort of where that goes. But Singapore particularly has been a bit more vocal about it. And so you'll see a lot of press releases coming out. Chile has done some work with IFRS as well. And so you'll see some stuff on the IFRS site about Chile. Canada, I think, mirrors the US. So they had this mandatory standard that was going to be issued. And as of April 2025, they sort of paused the mandatory aspect of it. There still is a IFRS voluntary disclosure component, but it's sort of sitting in the same limbo. I'm happy to look into if people are curious if on a province level we're seeing the same initiatives, but federally for now, it's on pause. And so that's kind of the global landscape at the moment where you're seeing IFRS pop up a lot. So that begs the question. There's like 8 million ESG frameworks. If I, as a business, report under IFRS, am I going to be able to sort of tick the box with these other standards? And I would say the answer is largely yes. TCFD, we have already sort of, I think, beat it to death, but is integrated into IFRS. SASB, for the most part, industry metrics are embedded within the IFRS standards. You have the CSRD, which again is under the European Union. There's a large degree of interlopability if you report using IFRS standards. GRI is very close to CSRD, and CDP, I think, has been doing a lot of work to sort of get aligned. And for the most part, I think what has been interesting, and I'm sort of checking my notes on the timeline, but a lot of these, what a lot of these groups have been doing, and you'll see a lot of press releases, is they themselves, as between themselves, have been doing a lot of work. And so I think particularly IFRS and GRI announced about a month or two ago that they're doing a lot of work to sort of standardize the interlopability. I believe now if you report, and Toma, you can feel free to correct me, but I believe now if you report under GRI, you, if not now, but shortly, should be able to be covered under IFRS. I know they're doing a lot of work in standardizing. But yeah, I think particularly you'll see, oh, there it is. Yeah, they're trying to align their standards, reduce duplication. Same with EFRAG. They've had a couple announcements. And I think sort of a side note, but you'll note that I think that generally that's been a trend. GHG and ISO, the International Organization for Standardization, which is kind of funny given the context of the conversation, just announced that they're trying to align on their GHG reporting. So that's to say we are in a context where, given the sort of pushback from businesses, you're seeing a lot of desire to standardize. So that gets us to like, what are the pain points? Because I've talked a lot about like the sort of benefits of IFRS, but you as a business, what are the things you have to consider? Reporting rules, they can be a bit confusing when it comes to decision making. Scope 3 measurement, particularly in terms of supply chain, sometimes you just don't have the data. Frankly, a lot of businesses are saying, we would like to do as much reporting as we can in terms of scope 3, but sometimes it's a bit out of our control what people give us and what we can include. And so you see a lot of data gaps. The big thing is it takes time to transition between, if you're using an accounting standard generally that you've been used to and you want to transition it to IFRS. And so I think there's a lot of accounting firms that have now been starting to publish. I think I noted here that Deloitte and KPMG have some guidance, but essentially what a lot of these accounting firms are doing, and not just for climate disclosures, but generally is kind of giving you the breakdown of what the difference between a local standard, these links have some of the US standards, are, and IFRS. And so you yourself can kind of make the decision as to whether or not you want to put a transition plan in place. But that's the big one. There's a bit of a front loading that comes to implementing IFRS. Scenario analysis requirements under the standards can be a bit more requested as well. There's an expertise that comes with it, a bit of being able to do the financial modeling and physical risks. And also just like assurance readiness, auditors' capacity to be able to sign off. I think we talked a bit about assurance, but essentially one of the requirements under these sort of disclosure reporting requirements that we're seeing on a regulatory basis is that some of these reports be audited and signed off. Um, and that I'll get into more later is no more standardized than the ESG regulation at the moment. And so you're seeing a bit of movement towards that. I think to sort of give a sort of legal example, what we're seeing on a really like taking it back, but on a practical perspective is, in contract negotiations, you typically what you'll have in cross-border transactions is if one party is using IFRS reporting standards for their accounting and one party is not, what you have is a sort of mismatch of expectations. And so, for example, financial reporting applications are typically one of my favorite examples, particularly when you're looking at post-closing conditions. So I think earnout mechanisms, definitions of financial metrics, and post-closing financial statements and audits. So I think those of you who have put that in a contract, sort of a standard, closing condition or post-closing condition. And I think the language is usually very vague, we'll issue financial statements and audits, and then, you move on with life. That being said, if those audits and financial statements are vastly different depending on what you're reporting under, you run into a bit of a technical problem. And so I think the example I always like to use is, this is more to do with EBITDA, but if seller receives an additional 10 million, if EBITDA exceeds 50 million within 12 months after closing, typically I think, whereas if you're in a jurisdiction where people are using the same sort of GAAP standard, it's easy enough. But now you kind of have to ask yourself, like, how are we calculating EBITDA? And so I think, little things like the calculation of certain items like leases, impairments, or development costs are treated differently under IFRS versus every other sort of GAAP standard. And so I think this was really what the push was in terms of a centralization of accounting principles is the more and more cross-border transactions we would find ourselves in, the more and more difficult valuation scenarios we would be encountering, and essentially the more and more litigation you would end up in. So I think one of the pain points that IFRS is trying to solve here is it, much like the Incoterms, like we all have to sort of agree on the definitions just because you are seeing such an increase in contracting across jurisdictions. So that's sort of the background of IFRS and how it plays into the technical and sort of nitty-gritty regulatory updates and some of the things you'll be exposed to. So I just want to, do a quick recap, but essentially the things to be worried about are business risks, regulatory demands and compliance, interlopability, and contractual issues in different accounting standards. So before I kind of wrap up and talk about IFRS, I just wanted to check in. Were there any questions? Did I bore you all to death?
Never boring. We had a one. I don't know if you can do like a really quick touch or feedback. Generally about forecasting feedback on the ever shifting compliance and regulations. Specifically, the question was wondering at what point this comes into effect for UK based medium businesses of 130 to 200 employees. So again, like looking ahead.
That's a very good question. So I think it's a bit easier, and I'm looking at my UK notes. I know that, we're looking at no earlier than January 2026. But that being said, I have to look at the exact cutoff. I always mix up all the cutoffs for when, because I know it's a similar sort of wave structure where they're starting with a much bigger cutoff in terms of the SMEs for the 100 to 300 range. I'll have to look at specifically if they have backed off on that or if there's something that's mandatory in place. So I'm happy to look into that. And I think, as always, we'll provide a link in the end, and we're happy to look into the sort of really specific business case questions on a separate basis for anybody who's attended.
Yeah, and I didn't know if you had one more thing that you wanted to share, Sarah. I
Yeah, I think just to wrap up here, I think uh, IFRS is moving forward with a number of projects. They're looking at biodiversity, human capital, social, I think, broader social capital. And so I think they have a number of initiatives that they're looking into in terms of accounting guidance. Um, it is projected to be the global baseline on climate change, with a few over local sort of exceptions. And then I think the big thing that's coming out is the assurance standards, ISSA 5000, coming in parallel. I believe the timeline for that was, um, I have to look in on the exact timeline. I think they said, here, wait, annual period starting on December 2026 is when they're going to try to have it be effective. And so the idea here is the auditing is not standard across firms, and so that's been a pain point for a lot of businesses. And so IFRS wants to ensure that auditors have guidance on how they're going to be signing off on these reports as well. And so that'll be towards the end of 2026. And then I think I mentioned this earlier, but IFRS Foundation has been collaborating with GRI and EFRAG for alignment. Yeah, I think this is, as I mentioned before, GHG and the ISO partnership, that was like 2 days ago, so that's fresh news. But I think the idea is we want the reporting to be standardized, we want the audits to be standardized. And so we're seeing a move towards standardization. And I think as a business, you put yourself on a much safer basis if you start even your voluntary reporting, if you're not currently subject under IFRS. And so I think the idea is if you want to be a bit more forward looking, this is a good standard to use, I would say. And again, I don't work for IFRS. This is just our projections based on the data and based on the trends. But that's kind of it for me. I'm here and I'm happy to answer any sort of technical questions. And again, if there's anything really specific to your business, we're happy to connect offline.
And that's great. Thank you so much, Sarah. And I just want to encourage everyone, if you do have a question, please do not hesitate to put that in the chat. We'll try to leave the Q&A towards the end. We want to hear from Thomas, certainly about leveraging tech. I am adding a link into the chat as well. Again, this is a webinar. Certainly there might pose the reason to have more one-on-one time. We'll be happy to chat. But without further ado, Thomas, leveraging tech. What do you got?
Yeah, thank you, Victor, and thank you for the first part on the regulation, Sarah. So now for this second presentation, I will focus more on the terrain, let's say, what happens in the reality when you have to do some IFRS reporting. And so now we'll explain a little also what is Greenly approach around that, especially as it's a new framework. A lot of companies are still exploring and still they want to leverage some automation technology to speed up the process and maybe connect these initiatives with other ESG reporting initiatives they've done in the past. So, for example, it can be CDP, SBTI, CSRD for European companies. And yeah, I will try to keep it for the next 15 minutes. So we have a few minutes to discuss and answer to the last questions. Okay, so if we go to the first slide, I think you still have the control on it. Yeah, thank you, Sarah. So you have here a general description of what is a typical rollout for an IFRS project. First, you have one step to do, and maybe that's the trickiest one, as it's still quite unexplored territory. It's doing what we call a climate scenario analysis. So it's a barbaric word, but just to say, at first, the regulation requires the company to identify all their risks and opportunities related to climate change and understand how those risks and opportunities, so either physical risk or transitional ones, will affect their operations and their finances. So it can be about turnover influence, CAPEX, OPEX, reputation, market change, so basically everything related to a concrete consequence for the company. So it's a financial materiality, not an impact materiality, what you can have in a CSRD or GRI, for example. And that's complex because you have to have a heavy climate expertise, for example, on physical risk, knowing all the different physical risks that could happen to all your locations around the world and at which intensity, and then convert those physical events into calculations to understand how it will affect your CAPEX, your OPEX, or your turnover. So that's the first part. So that means in the end, you have some climate resilient strategy developed for your company, and you can hierarchize the risk and opportunities for your company. So that will help for the second step, which is to describe all the disclosures you want to include in your report. So in IFRS, you have 4 pillars, actually the same as TCFD: governance, strategy, risk management, and then metrics and targets. And the idea is that within those 4 pillars, each company has to decide what are the relevant indicators to put. So if it's, for example, scope 1, scope 2, and also scope 3, if it's about carbon offset credits, if it's about physical risk description, etc., etc. And so that's where the climate scenario analysis helps, because it hierarchized in the first place the key areas of focus for the company. And an area of focus should be a disclosure in your final report. So you do that, and then that's where you have to collect all the data to produce the different KPIs, so the narratives, the quantitatives, the tables, the true, false questions, etc. So that means getting data from the climate scenario, getting data from your GHG assessment, from your decarbonization strategy. So from anywhere to fuel all those KPI that will land in the final report. And then at the end, so you have your full IFRS report. You have to integrate it in your annual management or financial reports. And sometimes, for some regulations or in a voluntary basis, you may have to audit your report by a third-party actor. So maybe the case, for example, at some point for California bills with limited assurance first. It may be also the case for Australian version of IFRS, also UK SRS. At some point, most of those regulation by 2030 will ask for limited assurance on the IFRS or IFRS-like report. Okay, so that's the big picture of IFRS process. And now, yes, the idea is to focus a little more on the key phases, and I will start with the climate strategy. So as I said, a climate strategy is an analytical tool that helps to understand the financial consequences of physical risk and traditional risk and opportunities in the companies. So basically make you understand where you will earn or lose money, why and where. That's basically that, and because of climate-related issues. So it may be quite complex, because first IFRS S2, which is the text where it mandates company to do it, is not very clear about the detailed methodology to deploy about this. They are clear, for example, on the fact you have to deploy several scenarios. So for example, 2 degrees of global warming scenario and let's say 3.5 degrees with full match, let's say a business as usual scenario. They are clear about the fact that you have to identify in the end accurate risk and opportunities, but in between, the methodology to determine the materiality of those risks and opportunities is quite blurry. So that's where, and you can go to the next slide, Sarah. Yeah, maybe the next one. Yeah, perfect. So that's where, at Greenly, we have developed a climate scenario analysis tool that helps to cover all those areas. So first, for example, by providing libraries of scenario, so let's say some templates that helps you define the different parameters that constitute your context that must be the core of your analysis. So global warming issues, all the policy will evolve, of the energy demand will evolve, the policies, the market demand, etc., etc. That's the first step. Then we also have many financial modeling tools. So basically, our expertise is to convert a physical risk event or a transitional risk event into operational or financial considerations. I take an example. Heat wave event may have a consequence on the productivity of your factories, because first, if it's hotter, your workers would work less because it's hard to work when it's 45 degrees Celsius instead of 25. And maybe it will also affect your machines, because at high temperatures, some equipments may have performance issues. And so if you have less productivity, you may have less turnover. And if you have less turnover, that's a concrete consequence of heat wave events at your different locations. It may be not the same in Arizona or in Paris or in Beijing, basically. So that's the second point. Third point, of course, because it's a complex exercise, we have an internal team of consultants that help you all along the way to make those choices on scenario, which risk to analyze, which parameters to put in the financial models, which assumptions, etc. And so that means in the end, we provide some dashboards that helps you to navigate among all these financial analyses. And basically, those dashboards will help you to understand where you have risk and opportunities, how much they will help you generate or lose money on different financial KPIs, so turnover, CAPEX, OPEX, EBITDA, and maybe other metrics. For example, it can be the share of investors that will be concerned by a specific event. So it would not be directly financial oriented. We would also help you define your materiality thresholds. So basically, for example, using financial best practices to define a CAPEX threshold above which it's material, same for turnover, same for OPEX, etc. And once you have defined all this list of risks, we will also support you in developing an action plan to improve the resilience of your company. So basically, that means either lowering the impacts of the risk or enhancing the impacts of the opportunities. And then we could rerun our models with those projections to make you understand how much money you would win or lose again with those action plans. And then, of course, as I said in the first place, all those results will be digested in the final KPI of your report. So everything will be automated from end to end until the final deliverable. Okay, so that's it for the climate scenario. And then there are a few other areas on the rollout on which our product also helps to deliver this IFRS reports. The second area would be about the data points definition. As Sarah said, and as I said a little at the beginning, IFRS has the great advantage to be flexible, meaning there are pillars, governance, strategy, etc. There are some guidance about what companies should do, but in the end, it's not as CDP or CSRD. They are not concrete, accurate data points to disclose. So do I have to put total gross scope 1 emissions in terms of CO2? Do I have to put a table here? Do I have to put the narratives there? So that means it's a quite heavy process for most companies that do it on their own to define the structure of this report and basically the different data points. And from the climate scenario analysis, filter only the ones that are relevant. For example, if you don't do any carbon offset initiatives and don't have any issues about it in the future, there is no point to put carbon offset data points in your report. So basically, that's what we help you do in the system, thanks to a mapping that we did internally between risk, opportunities, also impacts, but that doesn't work for IFRS, but that may work for CSRD, and data points. So for example, if you have the heat wave risk that is material for you, we will automatically activate in your data collection system the data points that help to describe physical risk. But if you don't have any physical risk data material, we'll remove all the data points in the automatic suggestions. So that's it for the, let's say, framing of the report. And then in the end, as I said, what we deliver is a way to generate automatically the document that will help you to do this IFRS reports. And again, we can do it because first, we manage the data points directly in our system. Those data points are directly filled in by all the previous modules we have. So it can be climate scenario analysis for the financial risk opportunities. It can be the greenhouse gas assessment with our greenhouse gas module, decarbonization strategy, carbon offset module, etc. So all our galaxy of modules in the end fuel all the KPI that are in the reporting app. So you don't have to care about, in particular, quantitative information that are managed automatically with our system, and also narratives with, by default, methodology notes, etc., that we generate in our backend or with some AI support for specific data points. And then, yeah, once all those information are ready, we generate some documents. We can also help you with an AI technology to create paragraphs and sentences around a data point. So you don't have to care about refining the content and only care about, let's say, the form of the report and the integration into your financial report. And then I guess I will be almost finished now. Yeah, of course, we have a lot of auditability features because of this assurance requirement that may come in the near or midterm future. Those auditability features may be about, for example, providing in the platform the history logs of everything that happens in your data points. So which users does what, where, about what in the system. Uploading all the attachments that relate to the different KPI that helps the auditor to check the relevance and accuracy of the information. Also, you have different roles in the platform. So you have, for example, data owners that have specific features to compute the data, validators that are here to control the work of the owners, and, for example, auditor role that will then review everything and score the compliance or the quality of everything that is completed in the system. And so then that's where you could have a dashboard, so the gap analysis dashboard that shows you have a compliance issue in this data point because we don't have any attachment. You have a quality issue in this data point because you use an industry proxy and not an accurate data from your own systems. And that's where you can develop some roadmap to improve your ESG reporting in the future with our recommendations on the most critical data points and the most critical issues you encountered in the different data points. Okay, and I think, yeah, that's all for my part. Thank you everyone for your attention.
Yeah, Thomas, thank you so much. Yeah, tools to help you get around ever-shifting environmental compliance. We have a question that's not gone answered. There's also some information in the chat that I just want to make sure people are kind of flagging. Sarah was kind to share a link, certainly in regards to the question related to UK. So I forgot who asked that, but that's there. Yeah, the question, I'm just gonna put it. Did you all have sight of that? The question from Astrid. I just want to make sure it's really just it's again, if I'm compliant to TCFD, do I then also fall under the scope of IFRS? I'm gonna just post it again.
So no, I will say it's almost a chicken egg thing, but I would look at it as IFRS is the big one, TCFD is the little one. So if you fall under the scope of TCFD, your only requirement is TCFD. But if you report using IFRS, you are de facto compliant with TCFD. So I think in looking at your analysis of whether or not you want to use IFRS, there's the TCFD compliance requirement is one of many considerations. So I think in terms of trying to figure out whether it's the right framework for you, I would also look at some of the things we mentioned earlier in the call about the centralization and whether or not you specifically do business in other jurisdictions that might require IFRS compliance. So yeah, the answer is no, technically.
Thomas?
Yeah, but I wanted to add a note on that. In practice, if you do IFRS, so of course IFRS is a merge of about 5 or 6 different frameworks today about sustainability. So the S2 encapsulates a lot of things, but in practice, let's say the work to comply with IFRS S2 is 95% the work you will do on TCFD as well, because the reporting structure is the same. The data points to report are more or less the same. There are a few differences. For example, on scope 3, TCFD says it's fully voluntary. And IFRS S2 is a little more directive and says you should really have scope 3 emissions in your final report. And TCFD also has more or less the same things as IFRS for climate scenario. So if you do IFRS, it's best because now it's just a question of a change of culture and branding around TCFD that should disappear in the common language, let's say. And then you will be better prepared because all new regulations now consider IFRS text and not TCFD text, which is now, let's say, decommissioned since 4 or 5 years. Yeah.
No, that's super helpful. I want to be considerate of the time. We have about 1 minute left. Obviously, this is a webinar, so we are happy to be a resource. I know Sarah and Thomas can certainly be around for one-on-ones, specifically if you have more questions in regards to anything you heard or maybe anything that wasn't addressed that's related to that. I'm going to put the link in there one more time again. Thomas pointed out to the obvious help that tools can be resources. I'd be remiss not to remind you, this is a Greenly webinar. And so if you really were looking to put something into action, you can click that link and just send an email. Happy to do a quick one-on-one and we can explore that a bit further. I'll give you 5 seconds because it can't be a terrible idea if you do it. So I'll give you 5 seconds to just click, send your email. But without further ado, immense gratitude for everyone joining from wherever you are. Huge congrats and thanks to Sarah and Thomas for the great work that you all did today. And I think you'll have access to this webinar afterwards. Were there any final words, Thomas and Sarah, that you wanted to add before we wrapped up?
Nothing from my end. I would just say I just want to give maybe 30 seconds. I saw a couple people were typing, but really grateful to be here. And to the extent you guys have any questions, we're always available.
Thomas?
Yeah.
Like some.
Sorry. I think it's okay on my side.
Okay, that's great. Well, thank you all for being here. Again, we're available to be a resource, and we'll see you soon.
Bye, everyone.
Bye,
Thank you,
everyone.
everyone.